Okay, so today we are starting resident individual taxation for resident individuals. Taxation of resident individuals. Now, this is a lot of stuff that the notes that I have given you. Do you really want me to write everything, or you can read the notes? We can go through notes. It's already summarized. Yeah. So if you see the page number 3, on page number 3, first of all, we're going to start from the business income or trading income. Then we will have allowances and losses. You don't worry about these things so far. Okay. After you have deducted the capital allowances and losses, you add other income, right? Adding other income. What is our other income? Employment income, rental, interest. Once you have added all of the income together, that gives you statutory income. Yes. You need to deduct a few things like loss, gifts. You get assessable income, you minus the reliefs, and you get chargeable income. So the definition of these chargeable, assessable, and statutory income is given at the start of your notes. What is statutory income? If you go to page number 1, what is statutory income? Statutory income is the full amount of the income which is net of capital allowances, yes, and any deductions. And then what are capital allowances? We will do them later on. So it's basically like this. You have your total income, or you can say statutory income. Statutory income. What is statutory income? It is total income net of capital allowances, right? From here, what do? You have to deduct your donations and gifts, less donations and gifts, and what do you get? You get your assessable income. Assessable income. Okay. Similarly, from your assessable income, we will deduct our reliefs, personal reliefs. There are many reliefs we will do later on. Once you have deducted your reliefs, the final income left is your chargeable income. Means you will apply the tax on this income, chargeable income. One more thing here I want to mention. Nations. Can you make a bit correction on your notes on the first page? On the first page, it says value of deduction. It is value of approved deduction, cash or non-cash donation times 2.5, right? Actually, this was previous rate. Now it is 3 times. So you can change the 2.5 to 3. This is 3. Okay. Okay, now let's first start with a question on how to calculate the how to calculate statutory income. Let's say I give you a question. I will type the question on your screen, and we'll see how to calculate the statutory statutory income. So let's say Mr. A Mr. A has received Mr. A received following during the years 2008 and 2009. Okay, so first of all we will explain the source of income. This is part of your question. So source of income, then I will say period, and then you have your amount, how much received. So the first one is your trading income. Trading income received year ended 31st July 08 is 14,550 in dollars. Okay, this is your question. Similarly, also received year ended, same trading income, year ended 31st July 09 is 10,360. Yeah, and your second income is your employment income received year ended 31st July 08, which is 18,000, or let's say 48,000. And similarly, second year ended 31st or December, make it December. For December 09 is 54,000. So the requirement is calculate the statutory income for the relevant year of assessment. So how do we calculate? How much will be the statutory income for both years? So you know, right, the basis period, how trading income is assessed on what basis? Accounting year end basis, right? Employment income is non-trading, so it will be assessed on calendar year basis. So we have, actually it's just the addition of both. So can you calculate how much will be the total statutory income for both years? So that means here, which 2 years of assessment are we talking about here? We are talking about year of assessment 09 and 09 and 10, because the income is taxed on preceding year basis, right? So wait, my laptop is okay. So you can say year of assessment, first of all, 10 or 9. Year of assessment 9. Year of assessment 09 and year of assessment, actually it's just the addition of both. So trading profit or trading income. Because it is assessed on the year end basis, so it's already given for the year end, so we'll just take all of it, right? So 14,550, and similarly the second we will take as it is, which is 10,360. But the important thing is it will be assessed in 09 and this will be assessed in 10, right? Because it is assessed in the income is assessed on preceding year basis. Similarly, you have employment income. Employment income. Can we take all of this or not? Should we take all of this? Yes, because it is assessed on calendar year basis and it's already your calendar year. So 48,000 and 54,000. Now, in this case, in this question, you were not given any allowances or capital losses. Therefore, we just add both of them to get the statutory income. So, your first one will be how much? So, your 14,550 plus 48,000 is 62,550. The second one is 10,360 plus 54,000, 64,360. Okay, so that was just for the start. Okay, now we are going to discuss the income. How many types of income do we have? Can I go to next slide? Income for individual, right? So we are going to talk about a lot of different types of income. The first one is your employment income. Trading income, interest income, rental income, and any other income. Okay, other income. And today we are doing the employment income. Okay. By the way, can you go to your notes? On page number 4. If you go to page number 4, I want to just highlight something. In Singapore, only revenue income is taxable. Capital income or capital gain is not taxable. What does that mean? If I sell a home or a car or a building, the profit that I make on that sale by default is not taxable. Yes, only revenue income means my routine income like employment, interest, trading profit, right? But is not always the case. For example, if I am in the business of selling cars or if I'm in the business of selling buildings, then that is my trading profit. That will be taxable, right? Similarly, there is a gray area between this. It's not always. This is a principle based approach. Principle means we'll have to see everything separately. Each case is separate case. So whenever you sell a non-current asset, the tax authorities will actually determine whether this sale was for the profit making or it was a genuine non-current asset sale. So how do they determine? There are 6 points given on the page number 4, right? So let's say length of ownership, point number 2. How do they determine whether something is a revenue income or a capital gain? How do they determine length of ownership? So if you buy a building, a very big building today, and you sell it after 2 weeks, do you think it was actually purchased to keep or it was actually purchased to sell? To sell, right? That means it was a trading motive, right? If it was trading motive, then it should be taxable, because you did not actually purchase it for yourself. You actually wanted to buy and sell it. So length of ownership, how much, for how long do you hold the non-current asset, right? Similarly, frequency or number of similar transactions. Today you buy a building, you sell it after 1 week, and again you buy a building. So this is, if you are doing this lot of time, then what does it show? It shows you are doing a business. Yeah, because if it's a genuine sale, you will sell it one time and then that's it. But if the transaction is happening regularly, that means it is a business, then it should be taxable, even if it is a non-current asset. Similarly, you have the motive, number 6. Maybe the prices of the assets are going up and you decide to sell at that time. That will show your motive. The motive was to make profit, so it should be taxable, right? So these are some principles that actually used by the tax authority to determine whether a sale was for business purpose, like to make profit, or it was a genuine non-current asset sale. So let's say I have used an asset for 20 years. Now it has become outdated. I want to replace it with a new machine. If I sell that now, it will not be taxable because that asset is not useful. So I'm not selling it to make profit. I'm selling it because I want to replace it with something new, right? So in that case, my motive is not profit, so it should not be taxable. They will, yeah, they will come in, they will intervene, they will see. I don't know how frequent, how it happens in reality, but that's how actually the rule is the capital gain is not taxable by default unless you sell it for profit motive, or unless you're selling, unless you're doing a business of those non-current assets. So that's your revenue and capital gain. So now if we move on to next page, employment income. We are starting the employment income. So can I go to next slide? Yeah. Employment income. So employment income, it should be only taxed in Singapore if the source is in Singapore. Employment income is taxed if the source, if it is sourced, if the source, sorry, if it is sourced in Singapore. Sourced in Singapore means the employment income is being received by a contract that was signed in Singapore. Okay, so you sign a contract, you start employment, you start your job in Singapore. That means who is paying you salary? Singapore employer. So it is sourced in Singapore, it should be taxed. But that also applies even if you go outside Singapore. Your Singapore employer sends you to 2 weeks maybe training or foreign mission. Okay, 2 weeks. So who is paying you? Your Singapore employer, right? Even if you're outside Singapore. So because the source is in Singapore, it should be taxable, right? So that's your. So how do we determine whether the source is in Singapore? How to determine whether the source is in Singapore? Determine source. Many things. Did you sign a contract in Singapore, right? Where was that contract signed? Or first of all, where the employment is exercised? Employment in which country is the employment exercised? Singapore. Is it Singapore? If it's in Singapore, should be taxable. Yes. Or where was the contract signed? Contract signed in Singapore. Or if you are working for a Singapore employer, that means he's benefiting, right? Even if they send you outside Singapore, and if you're working, if the benefit is being taken by the Singapore employer, that means it is your Singapore employment. Yeah? Who benefits? Singapore employer. If it is Singapore employer, then that means it should be taxable. Or who is paying you? Even if you are working outside Singapore, if your pay is coming from Singapore, that means your employment is in Singapore. Who bears remuneration cost? So that's your these are the factors that will be considered whether someone is the source is in Singapore or not. If it's source in Singapore, that means it should be taxable. Can we try question number 1? Mr. Eric Song, a marketing executive of Singapore company, travels regularly to visit overseas customers. That means even if he visits outside Singapore, these are the customers of the Singapore company, right? So who benefits? Singapore company. So these visits account for 30% of the time spent outside Singapore. That's irrelevant actually here. He tries to claim that part of his employment income as source outside Singapore. Will IRAS agree? No. IRAS will not agree, right? Because actually it's the Singapore employment. The source is in Singapore. So the answer to question number 1 is IRAS will not agree. Similarly, question number 2. Mr. Albert was assigned to assist in managing the subsidiary of his company in China. He will spend 1 year there and be paid by the subsidiary instead. Is the employment sourced in Singapore? No, because now Singapore is not paying for this guy. So this income is sourced outside Singapore, so it's not taxable. Now this is the case with normal employees. I think I mentioned, so the first one, the answer to this one should be no, right? Income is not sourced in Singapore. Last time I mentioned directors have a special case. They are not same as the employees. The director, where is the income source will depend on where is the company resident, right? So that you can mention here, special case for directors. Case for directors. Most of it is actually also given in your, or it's also given in your page number 5. Directors fee are source where directorship is exercised. Page number 5. Yeah. Where directorship is exercised depend on where is the management and control of the company. So it depends on where the company is resident, right? If the company is resident in Singapore, then income of directors is source in Singapore, right? It is sourced in Singapore. That means it should be taxable, right? And what do we mean by the company is resident in Singapore? Last time we did, right? The residence of individuals and companies. Resident company means management and control of the company is in Singapore. Okay, so however, you can mention one thing here. If company has no presence in Singapore and directors are non-resident, then income is not taxable even if the meetings are held in Singapore. This is a special case. If the company has no presence means we have nothing to do with Singapore. We are not doing any operations. We just hold our meetings there for the sake of maybe for the sake of meeting only. It has nothing to do. It has no operations in Singapore. We have no presence. In that case, the income will not be taxable. Can we try question number 3? Directors are non-resident. How much did you get for tax? It was difficult. It was difficult. This is new. I give you new. Indonesian? Indonesian time? Only 1 mark. Donation is 3 times now. So it's in previous questions, because previously it was 2.5. I will cover that. We will cover that. Okay, is it clear? So directors' employment income will depend on the company. Others will depend on what? Others will depend on this thing. If your employment is exercised in Singapore, then it should be taxable. If the contract is signed in Singapore, it should be taxable. If your Singapore employer benefits, taxable. If you are paid by Singapore employer, still taxable, right? Any questions so far? So now we see the types of employment income. Okay, what are the types of? It's not just the salary. It's not just the bonus that we will receive. There are a lot of things, and it's very detailed. Actually, the topic is very detailed. Employment income. Employment income. So what are the things that we have in employment income? We have salary, basic salary. What else? We have bonuses. Anything else we have? We have benefits, and this is the biggest part of employment income: benefits. Calculation of the benefits. You can get a question separately on benefits. So this is very important. It is a list of benefits that we'll cover. You have allowances. And so on. So the first one is your salary. Salary is taxable if the source is in Singapore. Salary. What is salary? It is a money received for services rendered, right? If the source is Singapore, then it is taxable income. It can be your wages, like it can be your hourly pay, it can be your fixed monthly salary, it can be commission. So examples can include monthly salary, hourly wage, commission, and so on. I don't know. Should be already, I think. It's hard. Usually it's easy. If during the last few days you were busy, right? With Angeline or something. Or alone. I was in class, right? Oh, I hope this time you fully attend, okay? Okay, salary was easy. Bonuses. There are two types of bonuses, okay? Contractual bonus and non-contractual bonus. You remember this? Bonuses. There are two types: contractual bonus and non-contractual bonus. So First of all, what is contractual bonus? Contractual bonus is bonus that is already specified in the contract. So, for example, every year on the Feb you will be paid a bonus. That's a contractual bonus, right? So, if that is the case, then when is it taxable? It is taxable when it is due according to the contract date. Okay. So, in your contract, it says every 3 years you will be paid. You will be paid a bonus, right? What does that mean? Every 3 years you will have to pay tax. The income will be taxable every 3 years, whenever it is due, right? So let's say, today or this year is 2016. Okay, my contract says in contract it says bonus 16 months or 13 months salary due in 2020. Yeah, even if I don't get paid in 2020, it will automatically become taxable in 2020, even if I don't get paid, because contract says it has to be paid in 2020. Okay, will I be taxed in 2016? No. 2017? No. 18? No. When it is 2020, it is taxable, even I get paid maybe after 1 year or after 6 months or whatever. Okay, so this bonus is taxable when it is according to the date mentioned in the contract. Okay, this bonus is taxable when according to date mentioned in the contract. If it's every year mentioned, that means it's every year is taxable. This bonus is taxable even if it is actually not paid or paid later. Not paid means if it was never paid, then of course you can claim the refund. However, if it's just a matter of paid later, that will not change it. It will still be taxable on the time. So that's your contractual bonus. So you can this bonus is specified in the contract. Okay, any question? Any question on the contractual bonus? No. Then you have the second bonus, which is known as non-contractual bonus. Non-contractual bonus. What is this bonus? This is one-off bonus that you get because you performed better, right? So your employer announces, well, you know what, I'm going to pay you bonus. It can be any time announcement. Okay, this bonus is not specified in the contract. This bonus is not specified in the contract. It is one-off bonus for good performance. When is it taxable? That's the important bit. It is taxable when it is paid. It is taxable when it is actually paid. What did you write? Yeah, declared and mean paid. That's for the contractual bonus. Yeah. That's for the contractual bonus. Non-contractual bonus is when it is paid. No. So you have to differentiate this between two, okay? The first one does not depend on when it is paid. It will automatically be taxed. Second one is when it's actually paid. So you announce it today. Will it become taxable? No. If you paid it next year, taxable next year. You change your notes. Dimitri. Handout, worksheet. 1 minute. Rates. Okay, so let's try the question number 7. This lady was paid a 3 months bonus of $12,000 for the year 2009 on 28th Feb 2010. When will the bonus accrue as taxable income to Josephine under the following situations? Question number 7. Oh, you cannot see. Maybe you remove this cable from PC and this blue cable. Blue cable. Yeah. Put it in this box. So, what is the answer to question number 7? There are two situations, right? A is if this bonus was specified in the contract to be payable at the end of each year. Second is if this bonus was not provided in the employment contract, it was additional bonus to reward the good performance. It was declared payable by the company on 31st Jan 2010. So when will it cannot just take it out. Maybe I don't. So can anybody tell me when it will be taxable in both cases? The first one, part A. Part A says, okay, first of all, paid in what? Paid in paid on 28th Feb, right? 2010. And the first part is it is payable at the end of each year. Payable at the end of each year. Means what? It was payable when it was payable in December. Although it is paid in Feb, but it was payable in December, right? So actually, that means actually payable in December 2009. Yes. So it will be taxed in year of assessment 2010. Yeah, so it's payable. No, this is contractual. If it's in it is specified in the contract. Actually, paid is non-contractual bonus. The first part is contract, right? The first part is your contract. Are you getting this? What is the first part? This bonus is taxable according to contract, right? And according to contract, when it was payable at the end of each year. Means it was payable, I will say here, actually payable in December 2009, right? Although paid. Are you joining us? Okay. So actually it was payable in 2009. So I will, if it's not clear, I will mention it like this: actually payable and paid. Actually payable in this December 2009, which is year end. Yeah, it's written in the contract, right? It says, right, if this bonus was specified in contract as payable at the end of each year. Because okay, one I will mention one more point. Paid in 2010, Feb 2010. So it should be taxable according to this date or this date. This date, right? That means it is 2009, so taxable in 2010 year of assessment. So taxable, it should be taxable in year of assessment 2010. But your contract may, your notes may be right as well. Why? Because it's payable each year, right? If it's payable each year, that means we can say maybe it's for the year 2010 paid in Feb 2010. If I look at that way, then it should be taxable in 2011. Depends on it is, because it doesn't say this one is paid. Is it for the previous year or the this year, right? If it is being paid for the previous year, then it should be taxed according to the previous year. If it is for this year, then it should be taxed in 2011. Jessica, clear? You need to both. Actually, there is one more thing. Amanda, where are the rates? Can you give so that you can copy the rates as well? 3 copies. 3 copies. All. Is it clear? Okay. The second part is, what is the second part? Payable. Contractual, payable, non-contractual, paid. Clear, Amanda? What about the second one? Second one says announced. It was announced in, when it was announced? It was announced on 31st January, right? 2010. Paid in Feb. Paid in the same, right? 28th is the same year actually, so it will not make any difference. 2010. Now when it will be taxable? So it will be taxable in year of assessment 2011. What what if it was like this? Announced on 31st Jan and paid in 2011. Then which date will you take out of these two? Which date are you going to take when paid? Paid, that means it will be taxed in 2012. Okay, so it's according to when it is paid. Now we are going to look at very small bits and pieces of the income that can be received by the employee as part of the employment. So the first one is your gratuity. What is gratuity? Is actually the lump sum for any reason that employee may receive as part of employment. So lump sum received as part of employment. It is taxable. Yes, it is taxable. Taxable income. It's not a bonus. It's a what should I say? It's not a bonus. It's just your employer decides to pay everyone some lump sum, or maybe uh, you were sick, or so you get paid a lump sum, or but actually it's not related to anything, because if you're sick, that will become part of your medical. It's just a lump sum. But is it very common? No, it's not very common. Is a separate thing. It's a separate thing. Then you have allowances. What are allowances? Allowances are cash or non-cash cash payment. Different purposes. For example, medical allowance, travel allowance, travel allowance, medical allowance, holiday allowance. Now, allowances are taxable when they are used for the private reasons, right? If I get paid something and I use it for the business purpose, then that means I never received it. It's used for the business. If I use it for personal purpose, then it will be taxable. So, for example, I receive a car, and the car is always used to pick and drop the employees. Let's say I never use it for my personal use, so that means it's not taxable. So only the part that is taxable is the private use. Allowances are only taxable if used for private purposes, private or personal purposes. Yeah. If allowances are used for employer, then they are not taxable. I don't have a question. Let the questions come. Then we do. Did you do any exam this time? Which one? F4. Oh, no, this time in June or September, yeah. So, can we try question number? Can I see this? Can we try question number 8 and 9? 8 and 9. Today we are here until 5, right? Last time we finished 1 hour earlier because we didn't know. So the class is until 5. Hmm? 5, 5. 4:30, 5:30. So question number 8 and 9. So what is the answer to question number 8? Question number 8. In in part A, is it used for the personal use or business? Personal, right? So how much will be taxable? All of it, right? So we can say, you can take each one set. So question number 8, it says how much is paid? $500 per month is paid, and all is used from. Okay, so you need to be clear that trips from home to office and back is a personal use. Okay, nobody says to me that you need to come to office on Silverbird. Okay, yes, so it's my personal use, how I choose to come to office. The office use would be I go from office to clients maybe, and so on, right? That's personal use. So 500 times 12 is your taxable income. 6,000, right? This is taxable income. In second case, how much is taxable? Yeah, uh, only 80% is taxable, right? Sorry, 80% of amount was used for taxi trips from office to, oh, it is business use, so 20% is taxable. So 500 times 12 times 20% equals 1200 taxable. Question number 9. This sales executive was given $600 per month entertainment allowance, and she spent 20% of the amount for lunch with staff. The remaining 80% was used for lunch with clients. So 20% is taxable. Yes, because 80% is for business use. So that means $600 times 12 times 20% again, equal to 1440 taxable income. Okay, then you have the overtime. Now you have this overtime payment. A lot of small adjustments. Okay, overtime. What is overtime? Payment means it should be your transport and food. So is it taxable or not? It used to be taxable, but now it's not taxable, provided you meet some criteria. What is the criteria? That policy should extend to everyone. So every person who works late overtime and gets let's say meal should be taxable now, because this policy extends to everyone. Also transport, everyone who works late will get the transport. If it's available to everyone in the office, then it should not be taxable. Okay, overtime, transport and meal is not taxable if this policy extends to all staff. And employees actually do work overtime. It's not like you get paid food within working normal working hours. That should be taxable if it is taxable. So that's a different from you getting paid food or meal outside normal working hours. That will be overtime. Consider. Okay, employee actually works overtime outside normal working hours. Okay. Are you visiting the IRAS website? Have you seen? No. You need to visit that regularly. Okay. Any questions so far? Then this is the overtime payment and like transport and food. If you are working in Singapore, if you send your staff to outside Singapore and you provide for transport and meal accommodation, then some part of that is not taxable. How much is not taxable? That will be given by the tax authorities themselves. If your employer pays more than that limit, then that will be taxable. So, sorry, if you go, IRS says you can only get paid $150 per day for everything, food, transport, but your employer pays $200, then the excess is taxable because you're getting paid more than limit. Okay, and we call it per diem allowance. Per diem allowance. This is the allowance for overseas trips. Allowances for employees on overseas business trips. Transport, accommodation, food, etc. So how much is taxable? It is taxable only if in excess of IRAS limit. So in bracket you can say only excess is taxable. So question number 10 says, Ms. Junita was given a per diem allowance of $150 per day when she went to China for 5 days. The acceptable rate is $128 per day. How much is taxable? The excess, right? So excess is how much? Question number 10. Taxable income is equal to, you have to take the difference, 150 minus 128. For how many days? 5 days. 110. So I go somewhere, like for example, when I go to Unilever, let's say, I pay from my pocket, okay, but then I get reimbursed. Those reimbursements are allowances? No. Those are the amounts that I have already spent for business, right? So is reimbursement taxable? No. Reimbursement is not taxable unless the reimbursement is related to expense that was my personal expense. Yes. So reimbursements are not taxable unless they are for the private expense. Otherwise, they are business expense. I'm just getting paid. It's like business is paying for itself, right? Reimbursement. Reimbursements. So first of all, reimbursements are not allowances. Reimbursements are actually expenditure by the company. By the company. Reimbursements are not taxable are not taxable unless reimbursement is in relation to private expense of the employee. Yeah. Yes. So if I get paid for something I spend for myself, then it's taxable. If I get paid for something I spend for business, it's not taxable. Just a reimbursement. Okay, then in relation to this point, can you highlight something in your notes? um, page number 6. It says special case reimbursements. These 3 points are not taxable. Now, the reimbursement for these 3 points from Jan 1st, 2005, following reimbursements are not taxable. Page number 6. What is not taxable? Taxi fares by employee from home to airport or from airport to home when they are going for overseas business trip. If you travel from home to office to home on taxi, is it personal use? Yes. But if you travel from home to airport or office to airport, that will be considered a business expense. So it's not taxable. Similarly, taxi fares from home to business meetings is also not taxable. It's considered business, and overtime meal and transport expenses. Yes? Yeah, these 3 points. If it's not for all employees, then it should be taxable, right? This one is for overseas. Yeah, you can mention this in the bracket. This is for overseas. The last one, point number 3. Overtime meal and transport expenses for overseas. Okay. Now, can I go to next slide? Exactly. No, actually, the second one is not overseas. The taxi fares from this one is even if you are in the home country, it's not taxable. The second one, taxi fares from home to business meeting. Business related, not taxable. Okay, next slide is your compensation for loss of office is actually also given in your the next point. What is this? The next point, compensation for the loss of office. For some reason, employees are made to leave the employment, right? You lose your position, and in that case, if your employer pays you any lump sum, is it taxable? It's not taxable. It is treated as your capital gain. Okay, it is treated as capital income. It is not taxable. It is not taxable. Where is Jessica? Jogja. She is also Jessica. You know that? When is your trip going? I heard trip is cancelled.
Yeah, they made their own trip to go.
So this is it was going on for a long time and at the end cancelled.
Actually,
Lot of messages on WhatsApp. Please payment.
yeah, because there's no payment.
Oh, there's no payment. Really?
Yeah, from the new batch it's not visible.
So you cancel it. So you just go yourself then. No,
They
the previous
can
batch.
go and themselves.
Previous batch can go. Just leave the new batch. And
Someone said it's for their event.
for them,
Yeah.
this is very crazy batch. You know that. You know what happened yesterday?
Yeah,
They were fighting.
I was there.
Oh, you were in the class.
No. I was there at the.
Oh yeah.
Yeah.
Not fighting, but
Yes, I remember that.
Rash and Reinhardt. Yash
And
is a new student.
anak baru. Oh yeah.
Anak baru
Terus
is white color.
kacamata. Beneran? Dia tunjukin.
Yesterday.
Yang satu pukul gua.
And they were sent out of the class. No, F3. I was not there. Not me.
Itu kelas Viras tuh. Viras jarang banget.
I thought it will happen in my class because I have already been angry 2 times. And I said to them, you will have to leave the class. But I didn't do. I thought next time will happen my class, but Viraj is the first one. They're so annoying, Okay. Benefits. Major area of employment income. Benefits. Benefits that you receive from employer. Home, car, tickets, medical, so on. They are also considered as part of your employment income. Okay. The first benefit is your leave passage benefit. Leave passage benefit. What is leave passage benefit? It is the air tickets given to employee for overseas trip. Overseas personal trip, not business trip. Business is of course not taxable. Which one is taxable? It is taxable if it is not taxable if it is given to Singapore employee, then it is taxable. If it is given to overseas employee to visit home country, some part of it is taxable. If it is given to Singapore employee to go and visit Malaysia or Singapore, sorry, not Singapore. Singapore is home country. If it is given to Singapore employee who citizen to visit some other country, taxable, all taxable. It's only not some part of it is not taxable only if it is given to overseas employees. Okay, I will mention that.